It's Mark Yegge here, wealth architect and lifestyle investor. Let's take your life to the next level. Welcome to the Wealth Architect Podcast. Hey everybody, it's Mark Yegge. Welcome to another Wealth Architect Podcast episode. Today's guest is a real estate investor. So we're talking about real estate today. He's the best-selling author of a book called Financial Freedom with Real Estate Investing. Pretty much sounds like what we're going to be talking about today. He's the speaker, leading authority on apartment investing, and he's the CEO of Nighthawk Equity, host of Financial Freedom with Real Estate Investing podcast, and columnist. He's a passionate guy about helping people become financially free by investing in apartment deals and raising money. Nighthawk controls $300 million in multifamily real estate, and in addition to his own investing activities, he's helped lots and lots of investors purchase over 40,000 units valued at over $1.5 billion. Our guest today is Michael Blank. Michael, welcome.
What's going on, Mark?
Oh, just living the dream, talking to cool people like you and hoping to spread the word about how people could take control of their financial life. So why don't you take us through a little bit about where you were and how you got to this point of getting people to invest in apartments and what you can do for them.
Yeah, talking about taking control of your financial life, I was definitely the opposite of that. And I grew up, being taught to go to school, get good grades, get a job with benefits.
Sure.
And I noticed that you were in the tech industry at one point. I got started in the tech industry as software. Actually, I'm highly educated, Mark. I have a master's in computer science.
Okay.
And so I started off being a programmer, spent a couple of years at AOL back in the mid 90s and joined a software startup called Web Methods in the late 90s, was one of the early employees there. And 3 years later, we went public in March of 2000. At the time, the most successful IPO in history. And we were all gazillionaires on paper, which was very exciting. And now, of course, you're all locked up for 6 months and you couldn't really sell anything. And that day, the day after, is when the bubble burst. So our stock price went from wherever it was down to very little in about 6 months. Nevertheless, put a bunch of money in my pocket. And I coasted for a while until I read the Purple Book, the awful Purple Book, Rich Dad Poor Dad in 2005.
Gotcha.
And like I said before, I thought it was a genius. And when I read that book, I was like, God, I'm such an idiot. Like my entire financial plan was predicated on, I don't know, making a salary and then giving Morgan Stanley as much money as I possibly could so that they could do whatever they did with it, which sometimes wasn't much. When I read this book, I immediately felt the urge to parlay this money into passive income so I can get financial freedom. It was a good amount of money, but it wasn't like enough for me to sit on my butt for the rest of my life. So I was like, I know, I'm just going to deploy this, invest it passively, get into a franchise, do these other things so that I have financial freedom. And in the process, I made a variety of mistakes. I deployed the money too fast. I got into a restaurant franchise, which worked well for a couple of years until the recession rolled around. And that experiment cost me everything. I lost all of my IPO millions in the restaurant franchise. And luckily, was able to add another $200,000 of debt on top of it to get myself out of the situation. So I went from having a bunch of money to zero to negative $200,000, and I flipped a couple houses in 2005 when I left my job to pursue this thing full time. So I just tried to dig myself out with flipping houses. As I was trying to extricate myself out of these restaurants, which took a lot of time. I traded options for a little while, did some iron condors for 18 months. That was really exciting, actually.
Sure.
And the restaurants was my big idea. It was my big idea, and that failed miserably. And so I went to plan B, which was real estate, and flipped 36 houses, and realized after 36 houses that flipping houses is actually a boatload of work, and there's nothing passive about it. And so I really scratched my head going, my gosh, what is this real estate investing thing? How can I actually build wealth and passive income? And I accidentally got into an apartment building in 2011, which was a nightmare in itself. It was in Washington, D.C., 12 unit there, nightmare. But after about 18 months of the nightmare, it quieted down and started sending me $1,500 in mailbox money. And I kind of forgot about it because it's so boring. And I went on flipping my houses until finally the light bulb went off. And I'm like, oh my gosh, real estate, passive income is where it's at. And it's not with single family houses or rentals or flips. It's actually with commercial property, in my case, specifically multifamily. And since then, I've pivoted and really went full bore into the multifamily side, have taught others how to raise capital to buy real estate and have amassed a portfolio of about $350 million as well. So today we train people how to do this, and then we also do the thing that we train. So my mission today is to help people become financially free with real estate. So if they got real estate on the brain, I can help them. If they're working the stock market, private equity, I'm going to talk to Mark.
I love it. Well, that's quite an intro and quite a history. So let me unpack one of the words that you said in there. It's a phrase, actually, not a word. It's called passive income. And I've always noticed that most things that are billed as passive income really aren't passive. I think maybe they're semi-passive. But usually the things that you think are going to be passive end up being a lot of work. So let's talk about that a little bit. What are you noticing?
Yeah, I don't think there's such a thing as true passive income.
Yeah.
I think that's a misnomer. I think that's unrealistic expectations. I do think there's leveraged income, highly leveraged income.
Yeah.
Right. So in other words, trading your time for dollars is a very unleveraged income. Business income of some sort is very highly leveraged because you're making money while you're sleeping. And that's the kind of income I like. I also like the kind of income where I can scale something without having to work harder for it. So for me, rentals and flips disqualified because the only way to scale is for me to work harder. It's much more difficult to build a business around it. And it's much easier on the multifamily side, specifically because the business model not only accounts for, but encourages professional property manager. I can't have that with rentals. I have some part-time real estate agents trying to manage my property and they want 10% of the income. And so it's much more difficult to build a rental portfolio because of that. But with apartments, it's an unnatural act not to hire a professional property manager. So in the multifamily space or commercial in general, I can buy a deal and then put a professional manager in place and then do it again and do it again and do it again. And my workload doesn't really get much higher than that. And so to me, I'm looking for leverage income.
You ever play that game called Cashflow from Robert Kiyosaki?
Love it.
I had a feeling you did. And in that deal, you grab a stack of cards and you pick off the top of it, kind of like Monopoly, and you read the card. And it's either a big deal or a small deal, right? So there's a big difference between a big deal and a small deal in there. Maybe talk a little bit about what that difference is with respect to apartments and your kind of thing.
Yeah, so the big deal is OPM, other people's money. And so my children, my kids who are now a little bit older, they have modified the Cashflow 101 game that allows them to essentially syndicate deals, right? Syndication means that you're using other people's money. And the difference between small-time single-family house investing and commercial investing is exactly that thing. It's this world of using other people's money and structuring a deal by which you do the work, and then the investors invest passively in this deal and they get a return on their money and get tax benefits. The world of syndication. And once you wrap your head around that, it opens up a whole new world. Why would you want to buy a single family house using your own money when if you in 30 to 60 days could learn how to raise money from and people who invest in the stock market, oil and gas and other alternative investments and educate them about investing passively in real estate, that opens up a whole new world.
Got it. So here's the question. People have been talking about this since, the Robert G. Allen days, right? And
nothing down.
Nothing down, yeah. And you go out, you find an apartment that's a Class C, and you rehab it, and then you fix it up, and then you do a cash out refinance, and then. But hasn't everybody done that already? Like, are there really any good apartment deals left?
That's a good one. You'd be surprised how few people do this thing. I really do. I think. There are the world of real estate investors is massive. I mean, there's so many people who have a rental or two or flipped a house here or two or done something. The world of multifamily is tiny in comparison. And this is the thing I want to change. If you can buy a house, you can buy an apartment building, right? So why aren't more people doing it? And so the question is, it's really around awareness and it's really around limiting beliefs or even false beliefs. For example, the biggest limiting / false belief is that I need 5 to 10 years of investing experience before I can get to multifamily is not true. And I need a whole bunch of money. I need money to invest. So I'm going to save up money, possibly get a HELOC against my house, and then I will buy a property. And both of those are limiting / false beliefs. And if you overcome both of those, the entire world opens up in a way that you never thought possible around scaling with real estate.
Interesting. So, so you're saying there's still plenty of deals to be had out there, even at these high interest rates? Would you still say that?
Absolutely. And it doesn't really matter if the interest rates are high because the cost of capital dictates the purchase price. The higher the cost of capital, the lower the purchase price and vice versa. So if the interest rates are high, that's okay. I just can't pay as much.
Yeah.
And so it's not really a problem as long as I'm underwriting or analyzing deals and I have high interest rates in there, then I will buy correspondingly, right? So buying with high interest rates is not really a problem in itself.
Yeah. So what are some of the hidden secrets or the hidden things that people don't know about when it comes to this?
Yeah, several things. So aside from raising money, that's a big one, right? But if you wrap your head on saving, raising money, there's a few other things that are new, that are different about apartment syndications that are not so prevalent on the single family house. One is the importance of your team. With single family houses, I didn't really need a team. Yes, I have a broker here and a general contractor. I'm talking about a team. Especially when you don't have a track record. If you call a broker or talk to an investor and they ask you about your track record and you're like, oh, I don't have one. Well, they're not going to give you a deal or give money to you. So you go away and you go back to single family house investing. But what if you built a team around you? What if you had a very experienced property manager on your team, a very experienced lender on your team, an attorney on your team, a CPA on your team, maybe even some kind of advisor on your team? Now, when you approach people, you talk about yourself in terms of the team around you. You never even talk about the fact that you've never in an apartment building before. You're talking about the property manager who manages 5,000 units, the lender who just underwrote $1 billion, and now your broker's like, oh man, this is a serious person, right? They're not going to question your track record because you already built this team around you, and therefore within 30 to 60 days, you can overcome this lack of track record. So that's a big departure from single family house investing. And the second, or the third, if you count raising other money, is joint venturing. This is, again, nothing that's not really relevant in single family. It's joint venturing. Now, why would you do that? You want a joint venture for something you don't have. So let's say you're a hustle, you're a bit of a numbers guy, and you out there and you can find deals and you're talking to brokers and you can get deals. But you're not really a relationship person. So the idea of you raising capital, you kind of resist this idea a little bit. Now, there's your counterpart. You could be a relationship person, and the sight of a spreadsheet makes you break out in a cold sweat. And from a personality perspective, you're more inclined to talk to people about raising money, and you resist analyzing deals. Now, in our ecosystem, in our student base, it's about a 50-50 mix. And so what happens, yeah, it's surprising. So from a personality perspective. And so what happens is those relationship people, we guide them more toward the capital raising route, and the more numbers-oriented people, we guide them a little bit more to the deal finder route. So if you are, let's say, a capital raiser, and you have the gift of gab, and you can talk to people, all you got to learn is how to raise money. Now your biggest problem is deals, because you don't really love numbers and talking to brokers. So guess what? We'll introduce you to your counterpart, which is a deal finder. And the deal finder has the opposite problem. They're out there looking for deals, but they really don't love capital raising. We put those two together, and now they're both doing a $4 million deal, because a capital raiser can raise $1 million, but can't find a deal. And the deal finder can find a deal, but can't raise $1 million. Put them together, and now you have a $4 million deal. And the cool thing about that is, unlike single family house investing, you actually get paid when you buy the property through an acquisition fee. So for example, for a $4 million deal, those two partners can split $120,000 acquisition fee. That's a big fee. And it's totally legal and disclosed, and it's very unique about this world of syndications.
That's a nice formula. Hey, it's Mark Yegge here to tell you about our cash flow machine trading program that's designed to teach you how to make safe, reliable income. Now, we shoot for 2 to 4% a month of income and growth in your portfolio. And we have courses to teach you how to do this yourself or inside a mastermind community. And the best part of that is it only takes about 20 minutes a week to implement. Now, while 2 to 4% a month doesn't sound like much, I show you exactly how we took my IRA from $111,000 to over $500,000 in just 19 months without huge risk. I'm not telling you this to brag, just to show you that you can do this too. So to learn more about this program, go to cashflowmachine.io. That's cashflowmachine.io, and you can learn more. Okay, now we've kind of gone from the end of this. Why don't you take us through like how a deal is actually found, structured, put together, closed, and take us through the timing more specifically of how that all comes together.
Well, let's do the structure first. Okay, so you have two roles in a syndication. One is this general partners or GPs, and they do all the work. They're the operator. Then they get these fees, and they also get some equity in the deal. 20, 30%, let's say it's 30%. Then you have the limited partners or the LPs. These are the passive investors. Now, they want to invest in there because they don't have to do any of the work. They have very limited liability. So if there's a lawsuit, they're not affected by it. They're protected by the law, and they will get a very good return on their money. Typically 15 to 20% average annual return. They're going to get a cash on cash return on their money, and they're going to get very unusual tax benefits. And this is a great partnership because the passive investor doesn't want to do all the work, but wants a good return on the money. And the active investor, the general partner, don't have access to all the capital, so they'll do all the work. So there's this split going on between the two, and that's why these syndications are really, truly a win-win. So what happens now is that the general partners, again, typically consisting of a deal finder and a capital raiser, the deal finder is going to go out there and they're going to look for deals, talk to brokers, underwrite deals, and if it makes sense, they'll put it under contract. And they will go out then and get the loan. They'll do due diligence on it, raise the money from the limited partners. They'll close on it and then put a professional property manager in place, stabilize the deal, and then they'll do what's called asset management, kind of like you have in private equity. You're kind of managing the asset, but in this case, you're not managing some kind of portfolio. You're managing a property manager, and you're making sure that they're hitting their goals and KPIs. Sometimes you have to make an adjustment and maybe replace the property manager if they're not hitting the goals. And then you're also reporting back to the investors. And then you try to do it again and again. So that's the general model. And this is why this works great for people who want to become active themselves as the entrepreneur. But it's also really good for investors who are looking for alternative investments, specifically in real estate.
Makes sense. And we haven't even touched on all the other benefits of real estate, the depreciation and the refinancing and equity, and equity appreciation and all that. But so just real quick, take us through the timing of that. You find a deal today, day one, whatever, and what happens from there?
Yeah, typically you find a deal, which is not easy to do. You have to look for a lot of deals, and you finally get in a contract. You typically have about 60 to 90 days to close on this deal. Okay. Now, 60 to 90 days is enough time for you to do due diligence and get a loan on it and put your property manager in place. It's typically not enough time to raise money in that time. So the best practices for you or the entrepreneur is to begin having conversations with your potential investors right now, long before you start making offers and doing things like that nature. So we have something in our world called a sample deal package. It's an investor package you put together. And everything about it is real. It's got real photos and numbers. You just don't have it on a contract. And so we use it as a conversation piece as you talk with investors to make them more comfortable with the idea of investing in multifamily or investing with you, answering some of the big questions and using the sample deal package as a conversation piece, right? So when the real deal comes up, time is short. And when that happens, you send them the real package, and now the conversation is more around specifics around the deal, but not around big questions like, what is multifamily? What are the risks?
Right.
Why should I invest with you, right? Which takes time. And so the idea is that you build relationships with people up front. So when you get a real deal, you can now actually raise money much more quickly because you've already had the more difficult conversations.
Wow. So, I mean, that's really the whole process is enlightening. And if you're into real estate, then, my dad was a real estate guy and a stock market guy and gave me the real estate bug, but I'll tell you, it's just too slow for me. So I'm a stock market guy. So kind of like you have your deal maker and your money raiser, we've got the stock people and we've got the real estate people. But I'll tell you, there's a lot of benefits in real estate. And, I always say there's two ways to get rich, the fast way and the slow way. And the fast way is the slow way. And real estate is the slow way, but it's a nice, slow and steady uptrend. And you can, get rich. I mean, they say most of the Forbes 400 is wealthy off of real estate. So listen, you've got a book, you've got a podcast, you teach people how to do this. You help, put together deals. How do people get a hold of you so they can get a little bit more Michael Blank?
Yeah, if you want to learn more about me and what we do, then we go to thefreedompodcast.com/Mark. So it's The Freedom Podcast for that Mark. And there's several different things you can see on there. You can learn more about Apartments 101. We have a training for the active investors called Apartments 101. So if you want to learn more about how to put the syndications together yourself, then Apartments 101 is for you. If you're more interested in passive investing, then we also have a little mini course about what does it mean to invest passively in real estate syndications. So the entry point is thefreedompodcast.com/Mark.
I love it. And then from there, people can get a hold of you and get more of you however they want, right?
Right.
Cool. Well, thank you so much for educating us about multifamily and putting deals together. And actually, the timeline I thought was pretty interesting as well. And I like the fact that you put a mock deal together, put it in front of your potential investors before you even go out and raise money for the big deal. Kind of grease the skids a little bit. Back in my day, when we used to raise money for private equity, we would call it circling the number. You're in for 100,000, you're in for 50,000. You do the same thing. So that's great. Listen, thanks for your time and your wisdom. and for being on the Wealth Architect podcast today, Michael. Thank you. And for everybody else, remember what I always say. Remember, don't give up your power in your health, your wealth, or your time. I will see you next time on the Wealth Architect podcast. Take care.
You've been listening to the Wealth Architect podcast with Mark Yegge. Follow us on iTunes, Spotify, or wherever you get your podcasts. Like and subscribe on YouTube. Share and tell your friends. See you soon.